Hello, welcome to today's webinar on Building Back Better, how social scientists and industry are working together to build new ventures that bridge the gaps in the green economy. I'm Horatio Mortimer. I'm from the LSE's Innovation Office in the Research Division. This forms part of the Aspect annual event. It's being recorded and will be available on the Aspect website. You can also watch many of the other sessions there too. Aspect is a consortium of universities working together to generate better impact from social science research in the commercial sphere. We have a really fantastic panel today who themselves each managed to span the commercial and academic social science domains. They're each going to talk for about 10 minutes, and following that we will open it up to questions from you all, which will be posted, which you can post in the Q&A. You're also welcome to contribute to the chat. The Q&A, I think only the panel will be able to see what you write in the Q&A, whereas if you write in the chat, everyone will be able to see it. So please do think of some questions to ask and put them down in the Q&A. I think you can ask them in your own name, or you can do it anonymously. So we're going to begin with Nick, and then Michal, and then Adam. Nick Robbins has a very distinguished background. He ran the Sustainable and Responsible Investment Funds at Henderson Global Investors. Then he ran the Climate Change Centre for Excellence at HSBC. He was then co-director of the United Nations Environment Programme's inquiry into the sustainable finance system. And now he leads the Sustainable Finance Research team at the LSE Grantham Research Institute, where he is Professor of Practice for Sustainable Finance. So he is a classic example of someone who's able to span the business and academic worlds. The focus of his work is on how to mobilize finance for a just transition. And he's going to talk to us about, in this moment of crisis, how can governments channel private capital into a green and inclusive recovery, and what financial structures could they use? Nick.
Well, thanks, Horatio, and thanks to everyone for joining today. It's really good to be part of this session, and I hope it's going to be very lively in the Q&A. So as Horatio says, I have a sort of practical background, and I'm very interested in applying insights from universities working in collaboration with communities and businesses and investors around the world to see how we can solve some of the big challenges of the world. Now, my experience is that actually the whole theme of green and sustainable finance has been pushed forward by crisis. First, the dot-com crisis of 2000, which showed how short-term markets were. Then the global financial crisis, which showed how the markets actually were not perfectly tending towards equilibrium, but actually were fundamentally unstable, and allowed notions such as the carbon bubble to come through and think about systemic risk from climate change. And now we have another crisis, not born in the financial sector, but with severe consequences. And I think this crisis will drive forward and will transform what we think about in terms of finance, particularly collecting issues about how we finance the economy of the future-facing economy linked to climate change and the restoration of nature, but also one that is fundamentally focused on driving down inequality and ending poverty. And these two agendas, the E and the S of ESG, have very rarely been connected. So I think we're in a huge moment of transformation. And what I've seen has been very exciting in the last 7 months, in the horrible tragedy of COVID, is how quickly people have come to this recognition that we need to build back better. The problem we have is it still remains in large part a slogan and has been very weakly translated into practice. And hopefully in the next few minutes I can give you a few ideas about how that could take place. As Horatio said, I'd like to touch on a sort of few mechanisms. We clearly have a global economic shock. We have the health shock with very terrible impacts on people and communities, but we have the economic shock, and we risk a global depression. So in that situation, when clearly people are losing jobs, people are losing incomes, consumers are not buying, the government has a huge role to stimulate the economy and use the fiscal space they have, and also deploy the resources of central banks to push the economy, to stimulate the economy in a direction that generates long-term well-being. I think it's striking in the UK, for example, that normally savings represent about 6% of the economy. The Bank of England estimates this year they could be about 15%. So you think there's huge untapped resources in the economy which could be deployed, and that's the job of government now. That's what they need to do in terms of building back better. So some of the mechanisms and some of the things that we've been talking about, clearly governments are borrowing a huge amount in the form of sovereign bonds from investors and going into debt in the process. But how can they link that to a green recovery, and also one that drives a just transition, whereby we ensure there are strong working standards, labour standards, community benefits of the transition to a green economy, and also that there's no one left behind in terms of the high carbon sectors, fossil fuels, and so on. So a lot of interest around green sovereign bonds, and one of the things that ourselves in the Grantham Research Institute at the LSE, also working with the Green Finance Institute and the Impact Investment Institute, so all the institutes working together, is the idea of a green plus sovereign bond. So this was, again, good research showing how the UK government could issue a sovereign bond to investors to finance a green economy, but the plus was doing that with social co-benefits. We were really pleased that this proposal has got the support of about 10 trillion in assets under management, large pension funds, large fund managers such as BlackRock, and we hope that the UK government will adopt this model to issue sovereign bonds, which really everyone in the country could invest in through their pension or so on. So that's at the high level. I think the maybe a smaller scale is there's huge interest in innovation in communities. We have many communities in the UK who have signed climate emergency declarations, local authorities, regions, and so on. And then obviously they want to put finance behind that. So through a group called the Place-Based Climate Action Network, which is the LSE, University of Leeds, University of Edinburgh, and Queen's Belfast, we've been thinking about place-based mechanisms. And one very entrepreneurial group that has come forward with some ideas is Abundance, launching the idea essentially of a crowd-funded green bond for local authorities in the UK called Community Municipal Investment. So this is something where you can invest very small amounts, a few pounds, in a bond issued by a local authority. West Berkshire has already raised £1 million, and Warrington is trying to also raise £1 million. Unfortunately, it's just gone into tier 3 lockdown, so that might have an impact. But again, I think that comes out of really good research and academic work. I'd like to acknowledge the work of Mark Davis at the University of Leeds, who's really been behind this. But that is led with Abundance, this entrepreneurial firm, to a very practical tool which can enable local authorities to raise capital to finance their climate emergency work. That is at a better price than they can get anywhere else. That's good for local authorities. And secondly, it creates a new form of civic engagement with local communities. So that's a second mechanism. And if we want in discussion, I'm happy to talk about also areas that we have been working on, particularly in terms of developing and emerging economies, which obviously have been hit hardest by this coronavirus pandemic. And maybe just to conclude, I'd really like to sort of think about sort of where are we heading, and I think as well as social science can really help us sort of what is the nature of the crisis we face. Social science can help in terms of actually looking at some of the mechanisms and tools we can use. I think it's also important to think about sort of what is the type of economy that we could be moving into. So clearly, we have a necessity to move to a zero carbon economy as fast as possible, one that is resilient to physical impacts, one that restores nature, but also one that is actually far more equal and far more inclusive. And we were very, very struck in the work we've been doing with the UK banking sector over the last year, how important this question of an inclusive economy and delivering climate action in a way that delivers positive social impact. So I think that is a sort of a new front, I would say, in the green economy. Not just thinking about environmental aspects, but thinking about how this shift can really help us deal with many of the underlying social issues, which we know in the UK are very stark and have been made much worse, sadly, in this crisis, but obviously at a global level as well. And I think, again, social science working with practitioners can really help to bring together these two challenges, and hopefully we'll have some success in solving some of them. So thanks very much.
Horatio is trying to introduce me, but he's muted, so we'll let him unmute himself.
Sorry about that. I was just going to ask, before I go to Michal, I was just going to ask Nick quickly whether he thinks that the barriers to financing a just transition to a green economy are things that can only be addressed by governments, or are these the things that private actors, and particularly social scientists, what can they do to mobilize green finance? Yes,
so I mean, I think all these big societal challenges like climate change, or indeed how we deal with it, so the just transition, are going to need to be shared endeavors. So we need governments to put in place the frameworks, policy frameworks to encourage a just transition. In Scotland, we have a Just Transition Commission, which the Scottish government has set up, but they've made their new National Investment Bank. One of its purposes is to support a low carbon economy with a just transition. So clearly, the government needs to do a lot, particularly now, because clearly the rest of the economy is on its back, and consumers and businesses are not spending, are not investing. So particularly now. But the just transition is about dialogue. It's about listening, it's about participation. So particularly in the workplace, having workers, their representatives, trade unions being involved in this process of change. It's about communities being involved in that process of change as well. And particularly has this place-based dimension, because the transition is not going to be uniform. It's going to be very different if you're living in Yorkshire if you're living in Cornwall. So I think that sort of place-based dimension is going to be very, very, very important. And therefore, new techniques in terms of engagement. We have had the Citizens Assembly in the UK, great success in terms of climate. Those techniques in terms of how you involve people, how you draw on the wisdom of so-called ordinary people, will be very, very important. Thank you. I wonder, I mean, if I wanted to invest in one of these place-based finance schemes, how would I do that? Very good question. There are very few of them around. So again, there are these community municipal investments which are being offered by Abundance. These, like all investments, and I'm not trying to promote them, come with risks. So investments can go up as well as down, and all the rest of it. But so that is one of, I think in the UK, is one of our real gaps. We have a pretty centralized financial system, unlike, let's say, Germany. And there are not that many mechanisms whereby you could invest in your local economy. Community energy schemes up and down the country, where you can invest there. But actually, that is an area of innovation, as well as being able to invest in national or international companies. We have very few avenues for that. There used to be regional stock markets UK. We don't have that anymore. So I think that sort of sense of sort of financial decentralization is one thing. So hold on to your money. It might be coming soon. Well, it'd be useful. It'd be useful if someone was able to put together, some advice to people, on how to find things like that. Anyway, thanks very much. So, Michal Nachmany
is a policy fellow also at the Grantham Research Institute at LSE, and she leads the structured data sets and tool projects supporting evidence-based decision making for investors and policy makers. And she manages two major projects, which I hope she's going to tell us about. One is Climate Change Laws of the World, and the other is the Transition Pathway Initiative. Michal.
Hi, everyone. Thanks for joining on this rainy afternoon. It's rainy in London. I don't know where you are, but hopefully the sun is shining, at least inside. Horatio started with asking Nick a question. Where do I find out, and how do I know, and where do I get advice for? And that basic question of how do I get my information to make decisions is actually at the heart of what we've been doing at the Grantham Research Institute with our structured data products, which is a big fancy name for saying we have been collecting and analyzing masses of data around two main topics that hopefully allow us to tap into exactly those questions. As Nick said, all stakeholders, from citizens, from kind of normal citizens to financial actors, to policymakers, to the business sector, everyone has a part to play in solving the climate crisis. Whether we move our pension funds to a pension fund that is invested in Paris-aligned assets, whether we change our electricity supplier, whether we invest in electric vehicle charging infrastructure as a country, all of these are decisions that need data behind them. Now, having data does not mean that you will make good decisions. Not having data or having bad data by definition means that you'll be making bad decisions unless you have some power of prophecy, which many of us don't possess. So in terms of creating those data sets and making them accessible to decision makers, again, on all levels, this is probably one of the more interesting adventures that we can be on right now. And what I want to go briefly through in this talk is talk about the need for those and explain a little bit about how these data have been used until now and where we think that are going to be used in the future. I would like to talk about well, the resources themselves, because you may find them useful and potentially take them back to your organizations and your own decision making. But also talk about what we still need, because we've become pretty good at mapping out the problems, and still we're not so good at mapping the solutions, and that's interesting and a way to advance into. So I'm going to talk about two main projects, and the first one is mapping the global climate legislation and policy landscape. About 10 years ago, a bunch of parliamentarians found themselves on the sidelines of the climate summit in Copenhagen and said, we really want to be making better laws and policies, but we have no idea what is out there, what works, what doesn't work. Can we please find out? They tasked a small team at LSE, at the Grantham Research Institute, with finding out. And that was the first climate legislation study. It was, a 20-page publication detailing the laws, the climate laws in 16 countries. We have since grown, made it into an online database. I believe a link to it is in the chat right now, covering all 200 countries of the world, all signatories of the Paris Agreement, and has on an ongoing basis. So we keep updating it, all of the laws and all of the policies that all of these countries have on their in their law books. And we've seen really, really interesting uses of this resource. First of all, we've seen governments use it in order to inform their own policymaking. From the Micronesian government to the Chinese government, all kind of looking through and saying, oh, I really need to update my climate law, or I need to update my transportation policy. What have others done? The process of policymaking, we like to think about it as a very neat process, but it often isn't. It often looks like looking at what others have done, copy pasting things, hopefully intelligently and not haphazardly, although we have seen many of those processes as well. And actually knowing what is out there, what is the menu of choices, is a critical element in allowing countries to advance their own legislation and policy. Of course, the reverse side is that sometimes policies really don't work or lead to unexpected or undesired results. Knowing what has happened and how to avoid mistakes, not only to replicate successes, is a critical element of that. I will add that we still don't really know how to do that. We still don't know how, except on a case-by-case basis, to say this policy was great because it led to reductions in emissions, to greater justice, to reduced vulnerability in communities, and so on. There isn't an overarching framework of assessing success of policies, and therefore, anyone seeking to learn how to replicate successes and avoid mistakes will have to do quite a lot of digging. So I promised you that I'm not only going to talk about the great things that we do, but also to flag the things that we still don't do. So let me flag another thing that we don't do. We currently only look at laws and policies by federal governments or by national governments, which means that a lot of action is not captured in state level in the US and in Canada, for example, in city level in hundreds and thousands in cities around the world. And sometimes this is where the real action happens. So if you look at the US, their federal record in climate policymaking is poor, if I'll use a polite word. However, there is a significant amount of action happening on regional and local level, which is definitely worth looking at. So in terms of where to develop these data resources, absolutely a direction to develop in. Now, the other thing in which we need to think about when we think about what kind of data do we need to advance our policymaking or our climate responses is how do we move capital in the right direction? And Nick started talking about that, and Adam will, I think, continue talking about that. And if we think about the decisions that all investors need to make today, then the level of data that investors need in order to make good decisions around that are humongous. With this, I'm going to move on to talk about the Transition Pathway Initiative, which is a project that we have been running out of the Grantham Research Institute for the past 3.5 years for a coalition of institutional investors that together have, I think, something like 30-something trillion dollars in assets under management. And those investors seek to assess what the highest emitting companies in the world are doing on climate change. How do they talk the talk? So what do their governance mechanisms look like? What kind of processes have they put in place? What targets have they set for reducing their emissions? And on the other hand, how do they walk the walk? What do their actual emissions profiles look like? And how do they compare to their peers, both in the sector and in investors' portfolios? So we have been assessing those companies. We currently assess over 400 companies and looking to increase that number in coming years. And what this data actually provides is an asset level intelligence portfolio for understanding how companies are doing in relation to their peers. This enables investors to do a range of things, from the obvious divestment to the high-level engagement through voting against companies and AGMs, through filing shareholder resolutions against companies, against management, and a variety of other actions. The data that the TPI is producing, the Transition Pathway Initiative is producing with its data partner FTSE Russell, is now going to feed into the Climate Action 100 plus net zero benchmark, which will look at the highest emitting companies in the world and rank them and place them in one against each other to see which one of them is doing better. I think that bringing this into COVID, the climate crisis and COVID are, I don't know if they're mirroring or if COVID is the little urgent brother of the climate crisis and the biodiversity crisis that looms behind it, and that it shows us what managing systemic risk looks like in helping us look at what inequalities in treatment of different populations look like, and at understanding that managing the movements of information and capital are critical to reducing the damage. So if we look at how we manage damage in COVID and how we're looking at moving from measuring deaths and illnesses to measuring policies and solutions and comparative solutions to that, we can see that this mirrors the climate policies and hopefully the green recovery, which is being talked about a lot and not being put enough to use, will go hand in hand with climate and biodiversity policies that in turn will probably reduce the risk for future pandemics. I'll pause at that. Thank you.
Thank you very much, Michal. I was wondering, listening to that, why do you think it is that investors themselves don't fill in the knowledge gaps that they have?
Sorry, can you repeat that? I didn't hear you.
Why do you think that investors themselves don't take the trouble to find out, the data that they're missing that they need?
Well, first of all, I think that they are. I think investors are increasingly, first of all, acknowledging their need to assess climate risks. And secondly, they are grouping in investor coalitions that together produce those frameworks and those assessment frameworks and those benchmarks against which they can measure it. The simple answer probably is that in order to measure risks, you need to define what questions you're asking and to define the metrics in which against which you will be measuring the companies. So if you're going to measure emissions in the oil and gas sector, you have to have super in-depth knowledge of the production processes in the oil and gas industry, which will be very different from how food is produced or how aluminium is produced. Those are being created. I also think that investors are at a point in time where they're mapping the problems and which is focusing on the heavy emitters and gradually, potentially, but slowly moving towards mapping the solutions, as in what do we need to do in order to move this forward? Do we need to change our portfolios altogether, which is the big divestment question? Do we need to engage the companies on doing differently on CapEx and on actual changing of their business models to be greener business models? And so on. So mapping those solutions, or of course, investing in completely different companies and renewable energy companies and so on. I think some of those questions are being addressed now increasingly. And investors are, I think, one of the larger and more interesting groups and climate activists that we're seeing today.
Thank you very much. We've got one question that's come in for Nick, but I think we'll wait until after Adam for him to answer that. But I hope that everybody is thinking of some more questions for our panel. Adam Parr is many things. He is an entrepreneur. He is an investor focused on university spin-outs. He is a graphic non-fiction author. He's a strategy expert, a historian, a former barrister, former head of the Williams Formula One team, and he runs Downforce, which is a charity that is helping devise better strategies against climate change. And I gather that he may also be doing his second PhD. Adam, he's going to tell us about, Adam's going to ask what, he's going to tell us whether there's a conflict between making a difference and making a good return from an investor's perspective. Adam.
Thanks, Horatio. I think it's perfect to follow Michal and Nick, because in a sense I'm sort of straddling those two worlds a little bit. I thought that it'd be useful to ask a couple of questions. First one is, what's a good return? Secondly, what does making a difference mean? And then thirdly, just to give some thoughts on, is there a conflict, or are these two things aligned? So on what is a good return, I'm mainly in the VC world, and in the VC world, I just think it's reasonable to say you cannot predict or calculate returns. Obviously, if you buy shares in the stock market, they have a yield. You can make an assumption about a portfolio of shares and where it's going to go over time, and what sort of dividends and capital gains you'll get. It's virtually impossible to do that in venture capital. And if you look at even the biggest funds, it's very hit or miss. You look at something like WeWork or Uber and contrast that with Facebook. It's a difficult game to predict returns. So what do I look for? I basically want to see, just talking purely financially here, when I invest, I want to see that there's a 10x upside on whatever I'm putting in and whatever stage I'm going in. That sounds enormously greedy, but if you do a little simple math, so if you compare, for example, buying a portfolio of shares which have a small yield, and over 5 years might see a 25% growth in their capital value, you'd be talking about a return of about 7.5%. If you have a portfolio of VC, and fairly typically, let's say 6 out of 7 of those just don't work at all, or generate 0 returns, let's say, and one of them gives you 10x, then you're going to get the same sort of return over 5 years, about 7.5%. So, the choice of putting your money into the stock market and getting a fairly predictable liquid asset and return versus VC, you need that when things are successful, they're very successful. When I'm doing sort of Dragon's Den type things, I tend to have in my mind this thing of 3 circles. So I have a kind of big outside circle of great ideas. And as you've heard from Horatio, based on my career, you can see I've always got great ideas about everything. Inside that big circle of great ideas is a small circle of great businesses. And inside that is an almost infinitesimal dot of great investments. Because even if a business is fantastic, it doesn't mean investors are going to enjoy it. It depends what they get in, when they get out, how they get in, how they get out, etc., etc. And it's astonishing how few founders actually think about what investors are going to experience with them. They tend to focus on the compelling nature of their idea. So that's about returns. In terms of what good impact is, I think there's 2 fundamental ways you can think about this. So either good impact is a dot, a subset within that little dot in the middle of my 3 circles. In other words, there's good ideas, good businesses, good investments, and then there's good investments that make a good impact. And obviously, by definition, that has to be a subset of good investments. It cannot be that good impact and good investment is bigger than just good investment. So that's a very small dot. And then, of course, there's another way of looking at it, which is to say that it's an outer circle, even outside my good ideas. In other words, an idea isn't good unless it's making a difference. A business isn't good unless it's making a difference. And an investment isn't good unless it's making a difference. So I think the way people tend to think of it at the moment is that good impact is a subset of good investment, whereas maybe we all need to be thinking about it the other way around, which is, why are we investing in things which are not going to make a positive impact? On that point, I would observe that many people I deal with who are working, for example, in large corporations that have set targets for net zero and so forth, they still think of climate change as a scenario. And I'm minded, of companies will have done risk analysis or scenario analysis 2, 3, 4, 5 years ago, where a pandemic affects their business. And of course we've had pandemics before, but they would have been thinking about a pandemic as a scenario. When you actually have one, like you have now, you realize that there's something different between a scenario and what's happening at the moment. And climate is even more extreme, because climate is not a scenario. Climate change is happening, and it's going to change the world, and it's going to change business and society. So I feel that certainly the larger corporations and many other businesses need to stop thinking about climate as a scenario in their forward planning, and they need to start thinking about it as a given. And once you make that mental change, I feel the way you're going to think is going to be different. So my final point I wanted to make was about disruption. There's a professor at Columbia who I admire very much, who misquotes Ernest Hemingway on purpose, who, of course, Ernest Hemingway famously said, and one of his characters said, you know, I went bankrupt gradually and then suddenly. And the observation has been made that disruption happens gradually and then suddenly. If you look at what Amazon's done to the retail sector in general, or booksellers specifically, it took 20 years. If you look at what Google and Facebook have done to the advertising sector, the same, and so on. So my point is this, is we can see what's happening. All the signs are there. And the key thing with disruption is to understand what is going to happen, if you can, and then to take action when you've got the resources, the cash flow, the strength to do it. So as an investor, I want to see companies that have gone beyond this is a scenario to saying this is going to happen. How are we going to be successful in an environment that is entirely predictable and not be simply disrupted by it? I would like later, if we get the opportunity, just to talk a little bit about pitching ideas and the social sciences, but I think it might be a good idea to pause there.
Thank you very much. That makes me feel, I want to just say something, ask you something as a devil's advocate based on an irritating column that I read in the FT yesterday or the day before. If investors start to shun environmentally harmful businesses, then their stock and bond prices will fall and their returns will improve. And investors who back this ESG trend will get rich. Is that correct?
Well, it's by definition correct that if asset prices are driven down, but the underlying business doesn't change, then the return to investors will improve over time. I think that, so for example, if you take a coal business, if the BHPs of this world get out of coal, then other people will buy those assets, probably at rock bottom prices, and they'll make great returns until they stop making great returns. And I think the answer is I'm afraid that there has always been money in doing things that other people don't want to do. It's always been true, and it's true today. And but I also think, Horatio, that one of my philosophies is don't waste your time trying to convince people to do things, right? That is just it's just a waste of energy. I like to work with people who've already made the decision about what they want to do, and their challenge is how to do it and how to do it quickly. And I think that's personally where one should invest one's time, is accelerating impact and helping people to figure out the way forward, not trying to convince them what they should do.
Thank you. Right, well, now it's time for Q&A. And the first question is a question for Nick Robbins from Joshua Grierson, who asks, in the journey to a net zero carbon economy, would the green gilt investment in low carbon non-renewable tech, and would it in low carbon non-renewable energy sources, would it include nuclear power?
So in the Green Plus Gilt proposal, which we did together as Grantham Research Institute and the Green Finance Institute, the Impact Investing Institute, that wasn't included. So the focus in terms of the sort of the power and energy sector was on renewables, I think largely because certainly offshore wind in the UK has shown itself to be able to generate substantial cost reductions, whereas sadly nuclear has not. So I think this was particularly in the context of the recovery. Renewables also has a much stronger job creation potential than nuclear. Obviously, nuclear is a low carbon technology, but we know the challenges it has faced over the last decades in terms of deployment in the UK, in terms of cost overruns and delays.
Thank you. And a question for Michal. I was wondering if you could say something about how the TPI program came about, and whether you have any advice to academics who are working with investors.
Sure, but I'm going to take advantage of the mic and throw in one more thought about nuclear, which is not a UK specific answer, but a global answer. When we think about nuclear plants that are large and by definition require massive investments, and we think of them against renewable decentralized solutions, we need to think about the financing of them. That's one thing. We also need to think about them in terms of adaptation, in terms of the ability to provide energy to communities that potentially are off-grid, and the equity and the justice that can be achieved by decentralized systems that can set up smaller scale, quicker systems up, and by that connect their refrigerators, their light at night, and other basic needs to the energy systems very quickly. So it's not just a big numbers question, it's also often a communities question. Nick alluded to that when he talked about jobs, and just throwing my sense about that. On to investors in TPI. Approximately 4 years ago, a group of investors led by the Church of England Pensions Board and the Environment Agency Pensions Board have decided that climate change is enough of a risk for them to actively want to monitor it and to deal with it actively in their engagement with the companies that they hold. They then created this consultation process with the LSE, in which they structured together, we structured together the set of questions that they would like to ask. Because with data, as always, putting out data out there without knowing what are the actions that you're going to be taking is a redundant activity. Only if you know exactly what you will want to do, including the creative things that you didn't necessarily envisage in the beginning, but you know this is data that I would like to use in order to engage with companies or to make investment decisions based on. So they structured a set of questions, again, around climate governance and emissions intensity, which was a semi-academic and semi-practitioner process, and put out this kind of basic staircase of companies and said, here are the companies that are either complete, let's call them climate deniers, because the companies on level 0 do not even acknowledge climate change as an issue at all the way up to the champions, to the ones who do strategic assessment of climate change, again in their public disclosures, and having the ability to lump those companies into those buckets and to say, here are the ones that I either really need to speak with about or that I really don't want in my portfolio, all the way to the ones that we can engage in a positive way with and say, you are the ones who are leading the industry, you are the ones who we rely on you to set industry standards, and this is the way that things happen. A couple of companies will say, okay, we are reviewing our trade association memberships so we don't lobby against the Paris Agreement. As soon as they do that and that becomes the standard, others want to do that too. We tie executive remuneration to climate targets. As soon as you get a few big actors doing that, all of the others say, okay, we need to do that too. That's what investors demand of us. And I think that mutual and bilateral engagement process with the actual stakeholders, and not just doing this as a pure academic exercise, is what can be attributed to the great success of TPI. Understanding your audiences in a very intimate way and continuing the discussion with them. It's always a very, very tied together process. These last few months, an incredible achievement has been made by the TPI, taking it even further, where TPI data has been integrated into the first Paris-aligned passive index, which was launched at by FTSE Russell, which applies the TPI methodology, which is open access, by the way, and anyone can take it, applies it to all of FTSE's companies. That's 4,200 companies, allowing that data to flow up into the places that it's needed in really ways that we didn't imagine, but we knew what was our audience and that we have to continue talking to them.
Interesting. Can retail investors buy that index?
I think not yet. I think it is still a tailored institutional investor index, but I think the great interest that has been shown in this, the Church of England as a first investor put £600 million into it as a first first investment, which is beyond our wildest expectations. I think that we will be watching the space for this. Not yet for retail, though.
And here's a question for all the panel. Is it true that there are vast lakes of capital looking for climate change solutions, but for some reason unable to invest? Who'd like to answer that? Nick?
Yeah, I mean, I think what is interesting is you now have over $100 trillion now signed up to the Principles of Responsible Investment. So that's clearly some form of signal of demand to include environmental, social factors to some degree. So that could be purely being done to mitigate risk and make sure your savings are okay. That clearly could be done to achieve impact, as Adam was talking earlier, and that could be actually done to actually make your investments aligned with goals such as climate, net zero goals. So clearly signing up ESG means many, many, many things. So 100 trillion. Now, in the discussions I've had, there really is apparently no shortage of latent demand for investments from pension funds and so on. Now that might be, in a sense, an issue. I assume there's a real lack of all the asset classes, whether that's going to be the venture capital that Adam was talking about, listed equities, the bond market, and so on. So that I think if you look at, say, the green bond market and
Nick,
the
you broke up for you broke up for a moment there. Can you just go back 30 seconds?
Yeah. That was my telecom system, not me. So yeah, so I think if you look at the oversubscriptions in the green bond market, you can see that there is a mismatch between supply and demand. So that's a real problem. And so I think particularly now, that's in terms of the crisis, where there's actually sadly very little investing going on, that the role of a sort of government recovery plan and using sort of scarce public to actually stimulate parts of the economy, regions, particular sectors like buildings and so on, is so important. But my sense is there really is no shortage of capital. It's really a question of structures and incentives and regulation.
So the technology is there, the money is there. Is the will there, or what? Well,
perhaps I could just jump in on that one, Horatio, because just coming back to social sciences, the answer is the solutions, the technology is there, right? It's not like we don't know how to solve this problem. It's kind of actually relatively straightforward. The money's there. And I think with COVID and building back better, there's quite a lot of political will. And there's also an awareness amongst people that if we decide to do something, we can do it, even if we build up debts of £2 trillion, we can still do it, right? And nobody seems to bat an eyelid. So all of the reasons not to do it have just disappeared in my view. So why aren't we doing it? And that's a social science question, right? Maybe a little bit of humanities in there. But I would love to see social scientists coming out of the woodwork a bit and actually addressing action and implementation and execution, and why sort of meta strategy. Why is it that, you know, if you take something like Grantham and the amazing work that you guys do there, you know, how do we get that impact deployed faster and more pervasively? Or the same with the Smith School at Oxford, where I am. You know, we're not short of ideas of what to do. What we are short of as social scientists is the ability to turn research into action and actually see that 55 billion tons a year of CO2 number just coming down a little bit would be, I mean, obviously it's coming down a little bit this year, but not for the right reason. So I'd like to see all this effort turning into impact. And that seems to me to be a social sciences question, which is why, although I am doing history to some extent at Oxford, I'm actually for the first time dipping my toes into social sciences, because I want to understand strategy and I want to understand action and how do you get stuff done.
I'm going to ask the panelists whether they have any questions for each other at this point. Nick, is there anything that you would like to ask Michal?
I think it hasn't come up now, but I think often in these debates, particularly when you talk about big companies, there seems to be a sort of a false opposition between so-called divestment and so-called engagement, suggesting that that I think in many cases, if you're going to be an investor and you're holding fossil fuel assets, and you can see those businesses going to the wall, that if you have fiduciary obligations, you have a duty perhaps to get out of that, and also you can send a signal. And I think as some investors are showing, like the Church of England, that you sort of engage up to a point and then you have to sort of let go and divest. So I think there's an interesting dynamic. It's often the tools that people choose, that they are alternatives. But I'd be interested to hear maybe from the other panelists, Madam and Michal, how different strategies work together. So how you blend different strategies in terms of engagement, in terms of investment, and so on, and not see these as often rather false polarities.
Sure, I completely agree with you that they are false polarities and that they're mixes that they can be cohabit. And I think that when we often think about divestment, we think about divestment from a sector. And I think what the TPI has done and following it, other frameworks, is talk about selective divestment from the poor performers in a sector. So you might want to not divest from all the oil companies, but you might divest from those who are the poorer performers and keep the ones that have made active commitments to change up their game, to strengthen their processes, to have committed to a just transition, have committed to either acquiring green businesses and to scaling back their fossil fuel activities and so on. And I think that indeed, you mentioned the Church of England. For those of you who are not aware, the Church of England in 2018 announced that it is starting to measure the companies in its portfolio, and the Church of England is a huge investor, against the TPI framework, and those that will not be aligned with the appropriate benchmarks by 2023, the Church will divest from them. So by that, it gave its portfolio companies a choice. You have 5 years to start moving, and some of these big corporations need this time in order to move. But by 2023, that's when we stop being forgiving. That selective divestment in a sector creates, of course, a race to the top, by which the poorer performers know that they will be held to a certain account and have the opportunity to do so. Now, the question about divestment, I think, is an interesting one, because we always need to ask, great, when you divest, who is it that's buying your shares? Within the context of just transition, I think that's a particularly tricky question. If you, as a responsible investor, sell your shares, it means that someone on the other end is buying. If they are just buying and then managing the assets in an irresponsible way, milking assets while they know that the price is right, while they know that the regulation is not in place to stop that, while they can treat employees in a bad way, and while They can let them go as soon as regulation kicks in, for example, I don't know, to shut down coal. I think those are tricky questions. And the whole question of responsible investment is sometimes about managing an asset rather than letting it go. So I think I think the jury's, I don't know if the jury's out or if we'll just continue seeing a multitude of approaches to that, but I don't think it's a very simple question of to divest or not to divest.
Interesting. We have a question from Carla Juavel, which is for Michal, but maybe Adam would like to answer this as well. You spoke about institutional investors engaging to encourage portfolio companies to improve and set emission targets. What about unquoted companies? What incentives would encourage them to move towards low carbon practices? And what do you feel this segment needs to make a shift towards reducing their emissions?
So I think it's an interesting, it's a great question. And the reason, of course, we started with publicly listed companies is because their information about them is accessible, and because there is a very clearly defined set of interested actors that want to know how those companies are performing. When it goes to unlisted companies, to private companies, they still have investors, but those investors need to think potentially in a less structured way about this. Now, when we think about what is the motivation of investors and of companies to move to a low carbon economy, we can think about it from a prism of risk. And if we think about it from a prism of risk, we can identify a few risks. We'll start with the pure economic risk. Look at what happened to renewable prices. And if you're a fossil fuel company, or if you're an emissions intensive company, you will see that your products are simply more expensive these days. Offshore wind is the cheapest energy source in the UK today. Coal mines all across the world are not worthy investments. And if you take away the subsidies that are heavily invested in them, are even worse investments. Insurance companies are moving away, and so on. So the price is really not right today to be in emissions intensive businesses all along the world. The regulatory risk is kicking in. So more and more countries, and it goes back to the legislation work, more and more countries are introducing legislation and policy that make green investment more favorable, definitely in the context of COVID, although we've seen both support packages for airlines and fossil fuel companies in COVID recovery packages, but we're also seeing a big green recovery story. And of course, another risk, which we don't tend to talk about, is litigation risk. Companies that are poor performers, that are emission intensive, and even that are, that just perform poorly on other environmental standards, are being subject to climate change and environmental litigation cases, which poses a huge risk both to them and to their shareholders. So I think that's another prism of risk to look through, and I think all of those provide sufficient incentives for any company or any global citizen, whether individual or corporate, to move away. Yeah, and I'm putting humanity on the side for a second. Anyone who thinks about what we're doing to our planet should be on our side anyway.
Presumably, when people divest, and it also makes it easier for governments to act.
I would probably answer with which government, but yeah.
Adam, do you have anything to add on that?
No, I think Michal's covered it very eloquently. Thank you.
Nick?
Yeah, no, I'm interested in more, Adam, and you touched on the impact theme. I'd be interested to sort of hear a little bit more about that, because it's I mean, there's one of the problems in this finance area, green finance areas. There's a lot of words which are bandied about, but often are sort of emptied of content, sadly, through overuse. So I'd be really interested, actually, Adam, just to hear more about maybe some of the investments you've been considering and the sort of impacts you're thinking about, whether social or environmental.
Sure. You've got about 15 seconds to answer that.
Okay, so my short answer is this: look at things which have an impact now with known technologies at scale. That's my criterion.
Sounds good. Lots of that.
Thank you very much indeed, all of you. That was an absolutely fascinating discussion, and thanks to everyone else for joining. We hope you found it enjoyable and insightful, and you will be able to rewatch the whole thing on the Aspect website. But not only that, you can also see all of the other events in the Aspect annual series. So do have a look at those. And also, we would value your feedback on the session. And I think once the session's ended, you may be in that irritating way forced into some short survey, and it will only take you less than a minute. But please do let us know what you thought, and we'll let you know when the recording is available. And I'd just like to say thank you very much again to our panel, and many thanks everyone.
Thanks very much.
Thanks, everyone.
Having me on. Bye-bye.
Bye.
Bye.